I spent 22 years in corporate before I made the leap into helping people own their own business. Today, I work with over 800 brands across the United States and Canada. In the next 45 minutes or so, I'm going to walk you through the complete franchise buying guide from start to finish. How to decide if franchising is right for you, how to pick the right type of brand, how to actually fund it, how the buying process works step by step, how you'll run the business from day one, and how to fit the whole thing into your life that you actually want. By the end of this video, you'll be more prepared than most people who book a franchise discovery call. Let's get into it. Before anything else, you need to honestly answer one question. Is franchising actually for you? Because the worst thing you can do is spend six figures buying yourself the wrong job. So I'm going to start by clearing up the biggest myths and getting honest about what franchising is and isn't. Why do most people start looking at franchising in the first place? Well, there's a variety of reasons. Some people, they're looking for a career change. Some people are looking to supplement their income or change their income or improve their income. Some people are looking for just more time freedom, freedom of space, freedom of choice. Some people, they're thinking about their retirement. They're thinking about how they're going to supplement their income post-retirement. And some people are just looking to expand their legacy. So the biggest myth about franchising is it's not a McDonald's anymore. It's not your Chick-fil-A. It's not your typical restaurants or franchises that you might see everywhere. The modern universe is 70 plus industries, and most don't need a storefront. You can run them from home. You can run them from the office. You can run them from a truck. You can run them from a van. They're literally everywhere. Maybe you see it, maybe you don't, but they're everywhere. And they're very versatile, with many of them that are suited for the work style and the lifestyle that you're trying to achieve. The honest income reality, it's all based on time, budget, effort, and is this truly the right fit for you? Is this something that you can see yourself growing and expanding over the next few years, maybe several years? When people ask how much can I make, there are so many dependencies on that. We're going to get into what that means and why you might choose a franchise that you never even thought of in the first place. But if it fits your criteria on your work-life balance, your budget, your preference in terms of location, who you want to support, what you're passionate about, then the income will follow. Income follows fit. It's not the brand. It's the fit of how that brand and that product and that service works for you. I've had candidates that thought they were wanting to get into the senior care space because it's a growing industry. Great. But when you think about it, senior care in general, that requires a very empathetic person. It requires somebody who has a bit of an HR background. You're going to be working with caregivers that are going to provide care for the seniors in which you are supporting, that trust you to have contracts with your company. So you have to be the right type of owner. I've had owners get into a space like porta potties and dog waste cleanup, something they never thought they would get into, but it fits and is suitable for their lifestyle. Now, obviously, these owners aren't going out and cleaning up the dog waste themselves. They're hiring people to do the job for them. But in terms of lifestyle, in terms of fit, in terms of budget, it suits them, so it works. Now, you may not want to get into the dog doo-doo cleanup business, and that's okay. But if you do, there's a lot of options there for you too. And you'd be surprised as once you have a conversation and you tell me about what you're looking to do, what you're looking to achieve, you'd be surprised as what can be uncovered for you in the right type of business and the right type of industry. So just a few seconds ago, we said the words income follows fit. That can relate to a few things. Again, it relates to your work style. It relates to what you're passionate about. It relates to how you want to approach your business. If you put in the effort, the income will come. If you feel passionate about something and you're willing to do the work and follow the processes that have been laid out, the income will come. If this isn't right for you, whether it's the wrong work style fit or the wrong amount of hours that you need to put in or the wrong type of ownership that you want to have, the income won't come. And if it does come, then the profitability won't be as high as you expect. So oftentimes I hear from younger people, hey, I'm too young to really manage a business. I hear from older people, hey, I'm too old to really think about starting my own business. And then I hear from people in the 30s to 40s range saying, well, I'm just too busy. I can't really think about starting a business right now. I have kids in school and I have all these expenses. The reality is the right model will present itself for the person in their 50s and 60s versus the person in their 30s and 40s and the person in their 20s. Typically, people in their 20s, they want to take a little bit more risk. They want to go out there, they want to try new things, they want to try something cool, they want to find something that fits their interests, suits their passions, and that's great. There are opportunities out there. I have a candidate in their 20s, which is looking at cryogenic chambers, for instance. I couldn't see too many people in their 50s and 60s looking into this, but you never know. That's a little bit more of a risky investment. Of course it is. And versus the person in their 50s and 60s, they're looking to find something that can supplement their retirement income, or maybe something that they can manage well into their 70s. And there's different options for them there too. Lawn care, for instance. They're not cutting the lawns, but they're hiring people to do so. It's a seasonal job. If they're in a cold climate place that has warm summers, they can work during the summertime and have their real peak periods during the summer, and then in the winters, they can go down to Florida and hang out and enjoy their retirement. People in their 30s and 40s looking to supplement their income or replace their income, yeah, they might be looking for a couple of resales, a couple semi-passive resales, but what if I told you that there are industries out there where people are able to make money from the first month and they're able to replace their income within their first year or their second year? A couple of good options for that is senior care or restoration business. If somebody tells me this all sounds too good to be true or this feels like a sales pitch, I've heard that before. My job is not to sell. My job is to consult. My job is to lay out the options, tell you the pros and the cons for each of those options, and then help you find the franchise that suits you. Some of them, yeah, they have tremendous upside, but the downside will reveal itself through the discovery process. The risks, the opportunities, they'll all be revealed. So it's in nobody's best interest to try to pull the wool over someone's eyes and walk them through a model which is not the right fit for them. Because the reality is, as you go through the discovery process with a franchise, you'll determine if this is the best fit for you. And if I am selling something that is not good for you, well, none of us win. We've all wasted time, and I've lost your trust. The same thing with the franchisor. It's not in their best interest to only tell you about the good stuff. They will tell you about the reality of their business, what to expect from them, and what they should expect from you. Because it's a two-way street. The franchisor is looking at you the same way you're looking at the franchisor. You both want a fit. And a long-term fit means you're not overselling. You're telling them the pros, you're telling them the cons, you're telling them the risks, you're telling them the opportunities. So that's the good part about franchising. If someone had a resale small business for sale, they might only tell you about the good parts, but then the numbers might show something different, and then everybody's time is wasted. I don't want to do that. When I have a discussion with a candidate and we talk about franchising and we're trying to determine if franchising is right for them, some of the signs that I look for is somebody who wants to make money, of course, somebody who wants to be a business owner, of course, but somebody is willing to follow a playbook that has been designed and implemented and achieved success many times over. That's the best part about franchising. Think about it this way. If you're somebody who likes to create a recipe, then start your business. If you're somebody who sees a recipe and wants to recreate it and achieve as high as profitability as possible by following a playbook and following that recipe book, then franchising is the way for you. Once you've decided that franchising is right for you, the next step is figuring out what kind. This is where most people get it wrong. They start by browsing brand names that they recognize. The ones who actually succeed start by knowing themselves first. Here's why brand name doesn't matter first. A logo is the last 5% of the decision. It's just the packaging. It's not the business model. Now, two brands, they can sell the same thing, but they may require a completely different owner. One brand could be very hands-on and ask for hands-on labor. The other one, pure management. Painting is a great example of this. Some painting companies, they expect you to be what they call chuck in a truck, which is that person that goes from house to house and performs the painting, has a very lean system, and does very well at it. Another company, they cater to more of the management type of profile. Someone who's an empire builder, someone who sees a business, who sees growth opportunities, who sees partnership opportunities, and can really grow a very long-standing business without even touching a paintbrush. The name won't tell you anything about that. It's about the business model. Starting with the name is like picking a house by the paint color before checking in if you can even afford the mortgage. Think of it that way. Now, looking at all the different industries, when people ask about franchising, they think about food. Everybody thinks with their stomachs, apparently. Food franchises are maybe 10 to 15% of what franchises are actually available. It's just the most visible because of the storefronts. But franchises goes way beyond food. We're talking about home services like repair and maintenance and improvement. We're talking about plumbing, HVAC, restoration, painting, landscaping. Business to business services like staffing and marketing and IT services, commercial cleaning, consulting, health and wellness like fitness studios or med spas or therapy and recovery concepts. We have education like tutoring and STEM, childcare, even things like test prep. Senior care like home care, senior placement, non-medical care. We have estate selling, all different types of franchises. So all of these go well beyond food. But the commonality between all of these is that they have proven franchise systems. That's why they're there. And that's why they have expanded across the United States and across Canada and across other countries in the world. Is because they're proven and because following the playbook will make you successful. Now let's talk about home services as it relates to three categories: enhance, maintain, and repair. So enhance type franchises are discretionary, upgrade driven types of franchises that focus on remodeling. Landscaping design is a good example of this. This can be tied to the housing market and consumer confidence. So discretionary spending. So if the economy is not doing so well and people are getting laid off, typically you might see this as less a priority. People don't want to add costly landscaping design to their house when they're struggling to make ends meet. Completely understand. But when the economy is doing really well, this could be one of the most lucrative opportunities out there. So yeah, there is risk, but there's a huge reward at the end too. So it depends, again, on your work style. Maintain. Now this is recurring, scheduled type of work. Think about lawn care, pest control, cleaning. This is like subscription style revenue. It's very predictable. This means that you're going to have more of an even revenue stream. Great for you. Will you get the highs from the discretionary upgrade-driven type models? Maybe not, but you'll have something more predictable in your hand at the end of the week. The repair model. Now this is need-driven. It's often very urgent. Think about plumbing or appliance repair or restoration. This is less discretionary. This is needed. And it can be very recession resistant. If somebody's appliance goes down, they need it to be fixed. And they're willing to put up the money to have it fixed. So this could be a great industry for the right type of person as well. Now, is it as recurring as the maintain model? No, but it's necessary. So really, as it comes down to it, enhance, maintain, repair type models in home services is used to filter on your risk tolerance and your cash flow preference. Do you want predictable recurring revenue, or are you fine with lumpier, opportunity-driven work? More highs and lows or more steady stream? It's up to you. Now let's talk about business to business versus business to consumer. So business to business, or B2B, means selling to other businesses. You're talking about fewer, larger transactions, larger sales cycles, very relationship driven, and generally about weekday hours. So you're working within your business time frame. Versus B2C means marketing to consumers. So you're talking about higher volume, lower average ticket, more emotional or reactive buying. And then weekends and evenings matter because that's when people aren't working and people are shopping. So business to business versus business to consumer can be very different based on your personality and your lifestyle fit. But immediately, as we go through that process, we'll be able to identify which one is best for you after we have conversation and learn about your goals. So I would often ask early, do you want to build relationships with a smaller set of commercial accounts, or would you run a higher volume customer facing operation? And honestly, the split is about half to half. So there's no bad way to go here. It just depends on your work style. Let's talk about owner-operator versus semi-absentee versus absentee type of work. Now, an owner-operator, they're the ones that are in the business daily. They're doing and directing and overseeing the work. This is best for somebody who wants that full control and you don't mind that grind. A semi-absentee person is somebody who works on the business, maybe 10 to 15 hours a week, while they have a manager who runs day to day. Now, this is great for someone who's replacing income while keeping other commitments, like another job even. An absentee or an investor is somebody who's fully hands-off, hires a general manager, functions like an investment. Now, this is best for someone with a lot of capital who wants a return and not a job. Now, all of these have pros and cons. The absentee or investor person has less oversight over the day-to-day operations of the business, and therefore there is a risk there. They have to make sure they have the right management in place and that they're doing a good job. Otherwise, there could be slips, there could be risks, there could be things that happen that they don't see that can cause a downfall of the business. Now, that's not always going to happen, of course, but the point is, even the most absentee owner still needs to be an owner and still needs to keep tabs on the business. It also depends on the type of industry you go into. A lot of people are inquiring about senior care, which is great. It's a booming industry and it solves a need. But you can't be an absentee or investor owner in a senior care business. That's just not possible. Now, a big question I get asked multiple times a day is, can you keep a corporate job while owning a franchise? The answer is yes, but only in models built for semi-absentee ownership, and really not every brand supports it. It almost always requires hiring a manager early, sometimes before the business even breaks even. This means the budget has to include management payroll from day one, and not as an aftersight once profitable. So your margins are going to be leaner, and you have less oversight over the business. And if something happens, are you going to be able to fix it? So when you're looking at industries and you're looking to be a semi-absentee or absentee owner, think about what would happen if you were not there. Would you trust it to work the way that you want it to work? Be honest with yourself. The owner's real job when you're semi-absentee becomes managing the manager. So reviewing the numbers, handling some of the hiring and firing, but you're not necessarily doing the work itself. That sounds great, but it has to match the business that you're buying. Now, a lot of people are planning to buy a family business that they can pass down. So I'm going to tell you about some of the right ways to approach this and some of the wrong ways. Now, one of the right ways, pick a model with enough structure and systems in there so that the next generation can step into a very defined role, not just help out. You want to find a way to build your management depth early so a business doesn't have to depend on one person's daily labor. If you're the person providing all the labor, you're the person who knows all the rules, all the tools, that's not going to get passed on to your kids as much as you'd like it to. Get them involved early and get them involved often. Also, write down your operating procedures, write down the way things operate, your vendors, all those different things. You need to have a playbook to pass down, just like franchises have a playbook to pass down to you. Another right way, think about multi-unit or scalable models if the goal is to build something substantial to hand off. So, you might just get one. You might start with one truck, but how can you get 5 trucks? How can you get multiple territories? The business has to be big enough where when your kids get older, they can start to be a part of the business, maybe even take over a territory, maybe even take over a couple of the trucks. And then from there, that's when you can start to pass on more and more of the responsibilities to your family. Now, the wrong way, buying a single owner-dependent unit and assuming the family will figure it out later. If the business can't run without the founder, there's really nothing to transfer. I've seen this a lot with a lot of resales. The owner is retiring. Their kids can't figure out the business, so they wanted to sell this to somebody who can. But the people who are coming in off the street to get this business, they don't know it either. Or maybe they know it a little bit, but they really don't know that business. Maybe they know the industry, but once they see the numbers and once they see the dependency that the business relies on the owner, they're not going to buy that either. So it really is something that will end up going away as the owner goes away. So make sure you do not buy something that is single and owner operator dependent. Build something that you can scale and transfer to your family. So by now you should know whether franchising is even for you or what type of model would fit the life that you want. But before I get to the money side of this, I want to pause for a second. If you're already seeing yourself in one of these models and you want to know whether it actually fits your capital, your timelines, and your goals, that's exactly what this call is for. Book a free 30-minute call using the link in the description. It costs you $0 because the franchise companies pay my fee, so I only make money when you find the right franchise. Now, let's get into the money. The next thing every first-time buyer wants to know is money. How much does this cost, and where am I supposed to find that money? Most people massively overestimate the first number and have no idea about the options for the second one. So I'm going to walk you through both, honestly. Here's the realistic range in this year, 2026. Most quality franchise opportunities today land in the 150 to 250 range. This is USD. But there's some that are a lot less, some that are a lot more expensive. Again, as I said earlier, it just comes down to what you think is most appropriate for your budget, for your lifestyle, and what you're looking to do. But really, this isn't your dad's franchising. 25 years ago, people pictured a fast food counter and a 6-figure buy-in with no financing help. Today, it's service-based, home-based, and B2B models with much leaner overhead, a much faster path to profitability, and a completely different funding landscape to match. Let's talk about the number $50,000. When you're buying a franchise for roughly $150 to $250K, you don't need the full investment sitting in your bank account. You could start with as little as about $50,000 in liquid capital just to get in the door. From there, you can supplement with financing. The liquid capital proves you can weather the ramp up. It's not the full price tag.
here's a few different ways that you can finance your business. In the United States, there's SBA loans. This is the workhorse of franchise funding. An SBA loan is a small business loan backed by the federal government, which lowers the risk for lenders and opens the door for first-time business owners. Now, a typical down payment is roughly around 20%. I've seen as low as 15%. Obviously, the higher the down payment, the better it is for you, because financing is still a loan and still something you want to pay off over time. Now, in terms of credit scores, that can really range as well. Typically, you want to see a credit score of about 685 plus to get a good loan from your SBA lenders. But honestly, this is one of those things you have to talk to your lender about, because everybody's situation is different. And so you talk to them, you tell the truth, you be candid about what you have and what you're looking for, and they'll be able to give you the best options. Another form of financing is called ROBS. ROBS stands for Rollover for Business Startups. This is funding with retirement money, penalty free. What this does is it lets someone roll over funds from their 401k or their IRA into a new business entity without triggering early withdrawal penalties or taxes. Again, this is not a loan. This is using money that you already have redirected legally into your own company. This can be very attractive for people who are transitioning from a corporate career where they've spent a lot of time filling up their retirement savings accounts, and they can use that to leverage into funding their new business. There's also security-backed lendings and home equity line of credit. Now, a home equity line of credit taps into the equity of your house, and this really makes sense if you have significant equity into your house that you've had maybe for quite some time, and you want a lower interest rate. Now, you're borrowing against the asset, which is your house. So that can sound like a little bit risky. And honestly, it can be in volatile housing market situations. But typically, your house is a pretty strong asset, and it's something that if you have the ability to leverage, it's definitely worth considering. There's also securities-backed lending. Securities-backed lending lets you borrow against a stock or an investment portfolio without selling it. Now, this makes sense if you don't want to disrupt your investment growth or trigger capital gains. And so this makes sense that if you have a really strong investment portfolio that's grown over time, and you want to leverage it and pull a little bit of money out to fund your business, it's a great option if you have the ability to do so. There's also friends and families financing. Now, this can work when the terms are in writing, the expectations are clear, and everyone treats it like a real loan and not a favor. Now, this is something, it can backfire when it's informal or undocumented, or when the business hits a rough patch and suddenly a family dinner turns into a debt collection call. Also, think about the personal relationships. It's very important that when you do something like this, that you do it for the right reasons. The relationship risk is real, so really treat this option carefully. So I have access to some really good franchise funding brokers, and what I like about them is that they understand franchising. They understand how to read the business case, they understand how to look at the franchise disclosure documents, they understand what to look for and how that translates to funding your business. Now, funding is its own specialty. My job is to match people to the right franchise and not underwrite loans. But a dedicated franchise funding broker knows which lenders are actively funding which industries right now, and that's something that can really shift monthly. And the best ones aren't found on Google. They build relationships through referral networks like FranServe, which is the brokerage I work for, because they're too busy closing deals to run ad campaigns. They're very fast workers, and they're able to secure your loan with relative quickness compared to some of the banks, which may need to understand more about the business and about more of the franchising process. So if you're looking for a franchise funding broker, let me know, I can hook you up. So you've decided franchising is right for you. You've narrowed down which type fits, and you understand the money side. Now we get to the part of this video that almost nothing else online actually covers properly: the actual buying process from the first call to the day you sign. Section 4, the buying process. Now, most franchise content stops at researching the brand. That's like saying the way to buy a house is to look at houses. There's a real process underneath this. And once you see it, you'll understand why some buyers close in 60 days and some spend years going around in circles. Here's exactly how it works. Step 1, you're going to have a 30-minute intro call. Now, this is just a mutual fit conversation, really nothing more. Think of it like a first date. You're getting to know a little bit about them, they're getting to learn a little bit about you, and you're going to see if it's worth continuing. They're going to tell you about their business, and you're going to tell them about you. This is where they are learning about goals, your budget range, your lifestyle, and the candidate is learning more about what this business is, and they're already starting to think about how they can make this operate well in the territory they're looking to adapt this business into. Now, if you're working with a franchise consultant, you've probably already started to think about this stuff because we've already had that conversation. I've narrowed down your choices and we've talked about what might be most suitable in the territory according to your budget. But this is your opportunity to actually convey that to the person at the franchise. Next, you're going to fill out a client profile form. This is a structured questionnaire which is going to cover your budget, your timeline, your skill set, your lifestyle goals, and other factors that will help them learn more about you. This is when somebody moves from curious to really in process. It's the first real investment of their time because now they're starting to really think about these things, and both sides are starting to think, is this the right mutual fit? This typically, honestly, is only going to take you about 15 minutes, maybe as much as 30. I've seen it take a lot less, but it's just an important part in this process. Next, you're going to have a deeper dive call. This is where you go really deep on the numbers and it turns from a dream to a little bit more of a reality. This is when you should come ready to talk about real liquid capital. You should already have an idea of what your credit picture looks like, who's kind of starting to buy in, what are your timelines to launch, and what success actually looks like from a day-to-day perspective. This is when we start to turn a vague wish list into a workable candidate profile. At this point, the franchisor is likely going to send you a franchise disclosure document, otherwise known as an FDD. Now, this is a legally required document every franchisor must share with their candidates, and is broken into about 23 standardized sections. This is the single most important document in the process because it's the one place where the franchisor has to spill all the information. And this is where they tell you about the fees, the cost to start a business, not just the franchise fee, but what does your first 6 months look like? What are your obligations? And it'll also give you a glimpse into the financial performance, not just marketing copy, but actual disclosure of real franchises and their performance history. Now, this is called Item 19. Franchises legally really don't have to disclose that piece, but many of the good ones choose to. Item 19 is the financial performance representation. Now, this is the section, if they choose to include one, which shows what existing locations actually earn. Now, you don't want to anchor necessarily on the average. Now, averages get skewed by a handful of top performers. There could be a few that are making several million, and there could be many that are making under a couple 100,000. So what you want to look at is the range, the median, and how many units are actually below the average, how many units are actually above the average. And then that's when you have to start to think about your market too. Where are these ones overperforming? And is that market similar to yours? This connects back really to the whole idea of income follows fit. The number on the page only matters if it matches the operating style and the market you're looking to step into. That's really important. Now, also look at Item 20. That's the health check. Item 20 shows the franchise's track record. How many units have been opened, how many have closed, and the ownership transfers over the past several years. You want to look at a good solid trajectory of units being opened and not a whole lot of units being closed. Also, a brand with heavy transfer or closures relative to openings is telling you something that the sales pitch really won't. That could mean that existing owners are struggling or bailing. It could mean that you need the right type of franchise owner to operate this type of business. So it's really important that you don't gloss over this piece. Next is a validation call. And this is where a candidate calls existing franchises directly and not references handed to them, but a broader list from the franchise disclosure document. I always coach candidates to call more than 2 or 3 of the names offered. Spread them across different tenures and territories and call during a normal business week, not a holiday stretch. Really ask the right questions. Some of the right questions are not questions like, do you like this? They're about actual day-to-day hours, real earnings versus what they expected, what did they do that brought them success, and most importantly, what would they do differently? Understanding other franchisees' mistakes will give you the opportunity not to recreate those mistakes for yourself. That's very important. Now, this usually happens after the validation calls, and this is when the candidate is starting to get very serious and is really considering that one option for themselves. This is an in-person visit to the franchisor's headquarters or a working location. Now, the goal here, again, is not a sales pitch. It's confirming the culture fit and really meeting the leadership team face to face before you sign anything. By the time you leave Discovery Day, you should have no doubt in your mind of what your next decision is going to be. And then you sign. You sign the paperwork, hand over the franchise fee, and you get to business. Now, you might be wondering how the broker fee works, how a guy like me gets compensated. I'm actually paid by the franchisor and not by the candidate. and this only happens once the deal closes. Now, my goal again is not to put you in the wrong franchise, it's to put you in the right one that's going to be most conforming to your life goals and what you want to do, because that ensures success. This aligns incentives also. Rather than me working against the buyer, I only get paid if the candidate signs and stays, so steering someone into the wrong brand costs me future referrals and reputations, not just this one deal. So I take it very seriously. Now, you might hear, I just need a little bit more time to think about it. Totally fine. Sometimes it's real. Partner hasn't signed off yet, financing hasn't been cleared, or new information just really needs to be processed. But oftentimes, this is fear dressed up as caution. By this time, you have done the research, you've validated the brand, and it just might be fear to commit. The way to tell the difference, think about what specifically is unresolved. A real hesitation names a concrete blocker. Think about what that blocker is, if that blocker is there, and talk it through. Now, fear-based stalling tends to be vague. I want to be sure, those type of things, with no real clear next step to get sure. Talk to people, talk to me. Think about what it is that's blocking you, and think about if that's enough to stall the deal or push the deal off entirely. That's the process from the first call to the signing. The last two sections are about what most buyers worry about more than they should: actually running the business and fitting it into your life. But before I get there, I want to pause for a second. If you've made it this far in the business and franchising is genuinely starting to feel like something you could do, that's exactly what this call is for. Book a free 30-minute call using the link in the description. The franchise companies cover my fee, not you, which means I only get paid when you find a brand that you actually want to keep. Now let me walk you through running the business. And so let's start with labor. Here's the type of labor that you will be hiring. And my line when I speak to prospective business owners is, you're not there to do the job, you're there to lead the people doing the job. As an owner, when you try to be the technician instead of the operator, the business stops scaling, and that's how growth declines. The owner should be spending time figuring out ways to grow the business and also leading the team so they can perform the labor during the day while you're focusing on the bigger picture items. And there's two types of labor that you're going to hire. There's skilled and there's unskilled labor. And this kind of changes the hiring equation, really. Unskilled labor roles are trained entirely by the franchise system, entirely by the processes. Think about entry-level techs, frontline staff, roles where the brand's process does the heavy lifting, and as long as they follow that process and the training documents, they will be completely fine. Then there's more skilled labor, and the skilled labor roles require a license or a trade background that the owner has to recruit for specifically. Think about your electricians, your plumbers, your healthcare staff. Some franchise owners, they might hire specifically skilled labor, thinking that the skilled labor can do the skilled job and the unskilled jobs. Now, this is not only a waste of money because you're paying the skilled labor more, but you're also not utilizing your skilled labor to their best abilities. So fielding sales calls, doing frontline staff work is not appropriate for skilled labor, so make sure you hire appropriately. Now, you might be asking yourself, well, how do I go and find the skilled labor and the unskilled labor? And this is where the franchise will help with the hiring as well. Most systems, they'll provide you with job description templates, interview scripts, and sometimes access to hiring platforms and regional recruiting support so you're up and running as quickly as possible. It's in the franchise's best interest to see their franchisees up and running and making income as soon as possible without any hiccups. Training and onboarding is typically standardized as well. So you'll get a mix of corporate-led initial training. Oftentimes this is at the headquarters itself. Plus you'll get in-field, on-the-job training from the franchisor's playbook. So you can train the trainer, you can train the staff as they come up and once you're more operational. And this really, again, is a system. It's not a guessing game. You're not building an HR department from scratch. You're leveraging the processes and the tools that have been already built for you, and you're putting that to work for yourself. Next is the big question we hear about all the time. That's marketing, and how do I find my customers, and who does the work? And the reality is this is shared. So the franchisor typically builds and manages national brand marketing and the website and the overarching strategies. They will also focus on partnerships and other major items that will move the brand strategically to a new direction. The local owner executes local lead generation. Now this can be things like flyering, door-to-door, shaking hands, meeting people, going to different businesses, introducing yourself, and that type of groundwork. But oftentimes you'll get templates, you'll get ad spend guidance, and you'll get a marketing coordinator or agency that the franchisor connects you with. So you're rarely doing this alone, and you're never doing this from a blank page. You'll always have some help along the way. And again, this is based on years of proven systems and marketing strategies that have been known to work. Let's talk about B2B versus B2C marketing engines. We spoke earlier on the video about what the difference between B2B and B2C is, and their marketing is very different as well. Now, B2B franchises lean on relationship building, like networking, referral partnerships, and direct outreach to other businesses and long sales cycles. B2C franchises lean on local visibility. This is digital ads and local SEO and review generation and more of an established community presence. Now, the skill set for winning customers looks completely different depending on which side of the line that your brand sits on, which is most appropriate for you. We talked about that earlier. But by this time, you already know. You've already got your business going. So you just have to figure out the right way to market and cater that to the type of business you're in and the industry that you're in as well. Another question people ask about is, what about real estate, commercial real estate? Do I need a retail presence? Not necessarily. For most modern franchise models, you don't necessarily need a storefront that people can see off the street or when they're driving down the road. A huge share of today's brands are home-based or mobile or service-based. You don't need that storefront. You may not need a lease. You may not need a build-out. Now, you might need a storage locker depending on what you're offering. You might need a small office to perform the hiring work and keep your paperwork and things like that, especially if you have a staff. Also, if you're in healthcare or health adjacent type of work, you might need to have an office that you've been registered to. But outside of that, you don't necessarily need a very expensive storefront. Now, for the brands that do need a location, the franchisor typically provides site selection criteria, the demographic requirements, and sometimes real estate support or with a preferred broker. The franchisor spends a lot of time and a lot of investment finding the perfect area for you alongside you, because it's in everyone's best interest to find the perfect location. Now, the owner, often with franchisor guidance, will negotiate the actual lease terms, but some systems have dedicated real estate teams that assist directly. So it's always good to leverage what's around you. Now, going back to training, here's some of the training that the franchisor provides. Most systems run initial training that covers operations, systems, sales, and sometimes technical skills. And this is usually over the course of 1 to 2 weeks at the headquarters, plus some field support after opening. I hear a lot, I have no industry experience. And honestly, that is most often always a non-issue because the franchise system exists specifically to replace the need for prior experience. It's about fit, not experience. And honestly, in some brands, it's actually a positive. That means that there's no bad habits to unlearn. There's no preconceived, hey, that's not how we did it at my old job type of friction. You're learning with a clean slate, and it's easier to understand how the new models work. You'll also get ongoing support after you open. So most systems assign a business coach or regional support contact for regular check-ins. When something breaks, whether it's operational or technical or a customer issue, there's typically a support line or a field rep, and you're not going to get radio silence. You're going to get active support. So you're never actually running this solo, even years into the business. That's one of the best parts about franchising. Now, you might be thinking, well, how much is all this going to cost me? I know I paid the franchise fee and I know I did the setup, but are there royalties? And yeah, there are royalties. Now, royalties is basically what you're paying back to the franchisor as a percentage of your gross revenues. A typical 5 to 7% royalty plus, let's say, a 2% brand fund, that's not a tax. It's an ongoing cost of staying inside a proven system. Now think about it. All that support you're getting, the training, the guidance, all the escalation support, the marketing support, the ongoing partnerships that you have with the franchise brand is worth 5 to 7%. In my opinion. The royalty funds continued research and development, marketing at a scale that no single owner can really afford to do alone. Also things like your tech and your software updates. And it also gives you group purchasing power. Everybody across the country is paying into this fund. So you get a higher scale of group purchasing power, which can lower some of the direct costs back to you. And then it gives you access to the support team. Also, some franchises, they have a call center and they have a lot more support. So orders that come in go straight to the call center and they go to you. Now think about the savings for that. You don't have to have a full-time staff employee. This is something that's been outsourced to a team who knows how to take orders and to field customer support requirements. That's a great plus. And the alternative, let's say you want to go independent because the royalties kind of scare you away, that's fine. But what that means is that you'll be paying for all of this yourself from scratch, and you'll have none of the buying power or brand recognition from the franchise. That's why I think if you're thinking about royalties as being a tax, it's really something that goes directly back to you. So think about that when you're thinking about royalties. The last piece of this guide is the part I see most first-time buyers skip. How does this business actually fit into your life, your marriage, your kids, your other career, your retirement plans? These conversations need to happen up front, not after the FDD lands. The conversation that needs to happen in week 1, not in week 10, is the conversation with the spouse or your partner. Any major decision like this is a household decision, not a solo purchase. It affects the family budget, the family schedule, and the family's tolerance for risk. Waiting until later on could mean that you're very emotionally invested in a brand before the person who lives with the decision alongside you has even weighed in. Make sure you include them at the beginning. You'll get another perspective. And to get that alignment is incredibly important. Do it as early as possible. Surfacing it early avoids the worst outcome. You come up with a signed agreement that blows up a relationship instead of building a business. If one spouse is excited and the other one is hesitant, don't force it. Bring the hesitant spouse into the process as a participant, not a formality. Include them on calls. Let them ask the "what if this fails" types of questions directly, and let them read the FDD themselves rather than hearing a secondhand summary. Hesitation usually softens once it's replaced with actual information instead of a partner's excitement alone. Information is key. Keep your spouse informed. Oftentimes I hear business owners asking about semi-absentee ownership. We talked about the earlier type of ownership styles, and this is around keeping your day job during your launch. Now, many franchise business models are built around an owner working about 10 to 15 hours a week rather than full-time, especially early on. The manager of the team will run the day-to-day operations while the owner really handles the oversight, the strategy, and the financial decisions. This sounds great, and this lets someone launch while still collecting a paycheck and benefits from their corporate job, which is reducing the risk during the ramp-up period before you can transition to something a little bit more full-time in a business ownership type of lifestyle. But launching a business comes with work. We talked about the training, we talked about being on site, we talked about having the right people in the right jobs. And so as a semi-absentee owner, you have to make sure that you're comfortable with handing over the reins to a good manager, because a good manager or a bad manager can make or break your business. Another thing to think about is your exit strategy, 5 to 10 or 15 years out. Yes, franchises can be sold, often to another investor or sometimes back to the franchisor or sometimes to an existing multi-unit operator in the system. Oftentimes it's also sold to new people looking to get into business. And also, similar to any other business asset, they can be passed down to kids or family members as well. Now, refinancing against the business is also possible once it has a track record of cash flow, similar to refinancing any income producing asset. So this can become a workable asset to help you expand your empire as you get further down the line and you want to increase your lines of revenue as a business owner. Now, remember when we talked about ROBS, the rollover for business startups, which is basically pulling your retirement income and using it as a loan? When the business is eventually sold, the ROBS funded structure can allow the proceeds from a stock sale to flow back into the retirement account it originally came from. So a very good option if you have a retirement funding account to begin with. This means the exit isn't just an income event, it can also replenish the retirement funds that help start your business in the first place. That sounds like a dream to me. We spoke about franchise resale, reselling to a brand new person. And what this does is it comes with a built-in track record. You'll have real revenue history, an established customer base, trained staff, and brand recognition already in place. So this makes the buyer pool different from an independent business sale. Buyers are often other franchise-minded investors specifically looking for a turnkey, de-risked opportunity rather from building from scratch. Now, I have two minds about this. I personally think that starting a franchise is better than purchasing a resale, because when you start from new, you know what you're getting into. You're getting into the right business, you're getting to the right business model, you're getting the right location, you're getting the things that work best for you, and you are learning from the ground up. Will it take a little bit more time to make income? Yes, but it's worth it. And it's probably cheaper too. And the money that you save by starting new versus purchasing resale will be more than offset by the income you get by learning the business from the ground up. But I understand why a resale is so attractive as well. And so it's up to you and what you're looking for. And that's where a guy like me, a franchise consultant, can help you out. So for most first-time buyers, the right move is nailing the first location. You're proving the model, you're learning the operations, and you're building a track record. This is when you can start to think about expansion as well. Multi-unit or multi-brand planning makes more sense when somebody already has operating experience, a proven cash flow, and a management team that can run location one without the owner being in the building every day. You can also shift resources and share resources across multiple locations as well. That oftentimes comes in about year 3 or 4, and when that happens, that's when you start to see your income potential really blow up. So in 10 years, you can have one franchise with multiple territories, or you can have multiple franchises with multiple territories. It's up to you, but this is how you grow and this is how you scale. So that's a complete franchise buying guide, from deciding whether it's right for you all the way to your exit 5 or 10 years from now. And if you've watched this whole thing, you already know more than most people who walk into a franchise discovery call will know. The next step is having a real conversation with somebody who can help you figure out which one of these 800 brands that I work with is actually right for you. Book a free 30-minute call using the link in the description. Again, it costs you $0 because the franchise companies pay my fee, so I only make money when you find the right franchise. Thanks for watching. I'll see you on the call.